There are two major types of risk faced by an auditor. First risk is audit risk. Risk that audit is willing to accept that the financial statement may be materially misstated and has unqualified opinion being given after the audit is complete. This type of risk can be controlled through adequate supervision, conduct of firm's audit practice in accordance with approved auditing standards. The next type of risk is auditor's business risk. Auditor's exposure to loss or injury to the professional practice from litigation, adverse publicity, or other event in connection with financial statement audited and reported. This risk cannot be directly controlled.
Now I would like to tell you about audit risk model. Audit risk model given three categories, which is the first one, inherent risk. The second one is the control risk, and last but not least, third one is the detection risk. Now I would like to tell you about the first one, inherent risk. What is inherent risk? Inherent risk is the susceptibility of an insertion to material misstatement in the financial statements in the absence of IC, structures, policy, or procedures. For example, like an auditor has assessed high inherent risk, which is the percentage of inherent risk of the inventory and the warehouse, due to large amount of the company by the several locations and their complex transaction. As for the assessment of inherent risk, there will be three, which are the knowledge of client business during initial of recurring audit, the integrity of management, and last but not least, the client motivation. As for the percentage of inherent risk, if the inherent risk increases, the ICS does not exist. However, if the ICS exists, the percentage inherent risk will be decreases. Now go to the next risk, which is the control risk. Control risk defined as the risk that material misstatement will not be prevented or detected on a time basis by entity internal control. For example, like human error, carelessness, faulty judgment, and communication breakdown. As for the assessment of control risk, there will be two. The first one is the segregation of duties, and the last and the second one, inherent limitation of internal control. As for the percentage of the control risk, if the ICS is effective, the percentage of the control risk will be lower. However, if the percentage of the control risk higher, the ICS is not effective. Now we're heading to the last audit risk model, which is the detection risk. Detection risk defined as the risk that substantive audit procedures performed will not detect a material misstatement that exists in accounts, balances, or class of transaction. Detection risks arise due to uncertainties that exist because, first, an auditor does not examine of all an account balance or class of transaction, or an auditor might fail to follow up on matters which are pre-inquired. As for detection risk, there will be two audit procedures, which is the substantive test and analytical reviews. As for the assessment of detection risk, there will be three. The first one is nature, which is given to an auditor what type of audit procedures to use for. As for the second one is extent, is for the auditor to select how many samples does the auditor to audit. And last but not least is the timing. Timing is when to start the substantive test for the auditor. Should be the test be done at the SOFP date or performed near the SOFP date in the company. As for the percentage of detection risk, if the detection risk is higher, the auditor does not to compete or not to care. As for auditors are to compete and care, the percentage detection risk will be lower.
Sampling. Auditors may use statistical or non-statistical sampling to perform tests or control or substantive tests. There are two criteria: representative sample. The first one is statistical sampling. Statistical sampling allows the qualification of sampling risk in planning the sample and evaluating the result. Statistical sampling also allows auditors to measure and control sampling risk. Non-statistical sampling. Non-statistical sampling allows the auditor to estimate sampling risk by using professional judgment rather than statistical techniques. In non-statistical sampling, those items that the auditor believes will provide most useful information are selected.
Reasonable assurance is expressed in the auditor report as obtaining reasonable assurance about whether the financial statements are free of material misstatement.